Thank you, Chair. Let me just mention that this is joint work with about 6 of us. Right now, there are 2 of us who are present, and I'll deal with the first 3 parts, and then my colleague will do the last 2 parts. We are just beginning on this process, looking at the segmentation of the interbank market. Essentially, the motivation is for us to establish whether indeed segmentation exists in the interbank money market. And the reason is we are interested as central bankers to ensure that this doesn't exist for the money market to perform its typical role of optimally distributing liquidity in the market. This ensures that monetary policy effects are effectively transmitted to the rest of the economy. Because once the monetary policy stance is changed, we expect that the interbank rate is going to respond. And this is this was the case in 2012 when the central bank moved away from monetary targeting to interest rate targeting. And we're using the interbank rate, overnight interbank rate as the operating target. So the expectation is that once the policy rate is adjusted, the interbank rate should immediately adjust and the pass-through should be complete. So that's the expectation. If that doesn't happen, then aggregate demand or inflation will not be contained. So we are interested in the interbank market functioning in that way. We also want to ensure that the banking system or the financial system is efficient and also is stable. The second point here just highlights the fact that structural rigidities exist in the market, but we are not testing for this at this stage. The other point we've noticed is that commercial banks continue to rely on central bank liquidity. This is given in the last panel on the chart on the last to my right, that despite commercial banks having ample liquidity, which is reflected in the right-hand chart in the gray shade, commercial banks still continue to rely on central bank liquidity, which is reflected here. This is the amount of trading that happens, that goes on within banks. The expectation would have been that with this amount of ample liquidity in the market, banks would not trade, would not have recourse to central bank liquidity. Instead, the volumes here could even be much, much higher. But we are not seeing this as a case. So the objective of this is essentially just to look at, to establish the extent of the interbank market segmentation in Zambia. There's been some work which has been done before, but this is unpublished by our colleagues in 2009. For them, what they did was to focus on a smaller sample, just a period of 3 years, and they just focused on the volumes. But for us, we are broadening the scope to look at the volumes and prices. In their case, they just looked at bank ownership, whether a bank is local or foreign. For us, we are now classifying banks based on asset. So we are not interested in whether a bank is foreign or locally owned, but we are looking at the size of the balance sheet. And we split banks into 3 categories using a particular measure where we just look at individual bank assets in relation to the total industry asset. And then we go further once we get that, that value now to get the proportion that each bank has to the total industry assets. And that informs whether a bank is small, medium, or large. And this is useful in our measure of segmentation, particularly when we look at the network framework, because the network framework focuses on whether a particular type of bank category, whether it's medium, large, or small, is able to trade with peers or across other categories of banks. So this classification of banks into medium, large, or small is useful for network framework analysis. We also look at the second measure of segmentation, which focuses on the preference of banks classified as such in terms of who they prefer to borrow from and who they prefer to lend to in relation to the amount of total borrowing and total lending in a particular bank category. The other measure we focus on is price differential. Here, we look at 2 things, because typically, if the liquidity cost was 0, as is the case usually for large banks, banks would trade around the policy rate, the central bank rate. So here we want to establish whether indeed this is the case for all the three categories of banks, whether indeed they trade around, because that becomes the benchmark. So we look at the deviation of the actual lending by the three bank categories in relation to the policy rate. So the deviation informs the extent of the segmentation in the market. We also look at the other measure, which is, this is the classification of banks. We are focusing on 14 banks. And for the 14 banks, we note that 5 of them are small, according to this measure, 5 are medium, and 4 are large banks. We call them big. So we want to see the extent of the interaction among these banks. So this is typically the framework analysis that we report on based on the data that we analyze. So the preference by banks in terms of lending and borrowing is calculated using this approach, where we look at total lending of funds by category X of banks to category X, category Y, divided by the total lending of a particular class bank. The third level of market segmentation we focus on is the Hess exponent, which looks at a particular value. And essentially, this is looking at the range, the persistence in the pricing behavior of banks. So it has 3 parameter values. So here, if the value falls between 0 and 0.5, it means that the data process is anti-persistence. And if it falls between 0.5 and 1, there's persistence in the pricing behavior or memory. And if it's 0.5, there's independence, so the behavior is kind of random. But here we conjecture that if there's market segmentation, the value of the H parameter should be different across the 3 bank sizes or classification of banks across the 3 types that we have come up with. But if the parameter value of the H is the same, then that informs us that there's no price segmentation in the market. Then we go further and look at the, because we're focusing on the overnight interbank rate, so we look at the lending rate. And what we do is we divide banks according to their trading pairs. Since we've got 3 categories, it means that we have 9 trading pairs in total. And then we look at the lending rate for different periods, and then we detect a structural break. Now, these structural breaks relate to specific events that could potentially impact on their pricing behavior. So effectively, we are looking at the H parameter or value. Is the parameter affected when these events occur? And most of these events relate to the change in the monetary policy stance. So if that alters the value, then it means that the pricing behavior of banks changes in response to the change in the monetary policy stance. So we do that for the different pairs, and this is essentially the dates that, or events that we came up with.
Okay. Thank you, Jonathan. So I'll pick up from where Jonathan had left. I'll go into the preliminary results that we have. So when we start with the network analysis, we see that the kind of structure that we see in the Zambian interbank money market is such that you see it's not complete. Neither is it incomplete and disjointed, like it's been put in theory by Allen and Gall in their work in 2000. So you see that there's trades across segments as well as intra, but they are not complete. It's not every bank that's trading with another. Neither is the kind of trades just amongst neighbors, like there's a structure that is termed incomplete structure, where you only see trades amongst intra and across trades only clustered around the neighbors. But here you see that the trades are well spread around. When we go on just to see how many credit lines are utilized within each space. It's like a simplification of, this is like a simplification of this exposure matrix that we build here. So when you see from here, we see that only the large banks utilize total available credit lines with peers, and it has 100%. All these are percentages. So within each box, if I can call it this, in this matrix, it's just showing the percentage of possible credit lines that are utilized when you look through the whole period of the study. So you see the small banks also quite interact so much, but it's not complete. It's like 95%. When you look at the case when the big banks, or rather the large banks, are borrowing, most of the times they are borrowing more from the medium. When you look at the lending side, it's almost fairly distributed between the small and the large. When you look particularly for the medium banks, is where you find that only 50% of possible trading lines are used. So it's the one that you see, if you see amongst peers, it's the one that has the smallest. If you look at there, it's only about half of them that are used. So when you see that when the medium banks are borrowing, mostly they are borrowing with the large banks. And when they are lending as well, it's also the same case. And you see most of these kind of market structure is premised on credit risk. So most of the trading preferences, or rather the credit lines, are set at the beginning of the year by the board, assessing each counterparty's assets as well as liabilities, especially the non-performing loans portfolio. So this is very critical, and what you'll tend to see that it shows a source of market segmentation. Okay, I won't spend so much time here. This just shows that if you look year by year, we've not seen a significant change in the market structure. We see has there been any change throughout the years. And you see, if you look at annual exposure matrices, they just show the same picture as stated. So now we go on to look at the intensity of trading. What we had seen earlier was about how many credit lines are utilized. But in this case, we want to see how much of volumes are going. Because sometimes you might have a lot of credit lines utilized, but are the volumes speaking to it? So when you look at the preferences in terms of lending as well as borrowing, you see for the large banks, we see that when it comes to lending, they are lending amongst peers. And when it comes to borrowing, most borrowing is with the medium banks. When you look at the volumes, this is just strictly into volumes. When you look at the medium banks, you see that most of both trading, when it comes to lending and borrowing, is with the large banks. And when you see particularly the medium, some of them are because of just asset size, but some of them, when you look at it, about two of them, if you're looking into detail, you might find about two are very risk averse, and so they are most comfortable in dealing with larger banks than the small banks or even peers. When you look at the small banks, they are trading. When they are borrowing, it's mostly with the medium banks. Of course, when we saw earlier utilization, we had lower utilization of credit lines with the medium. But when you look at the volumes are higher. And then when you look at lending, it's more with the peers. So going on to look at pricing differentials, when you look at the expectation, as Jonathan said, is if the liquidity cost is zero, or the cost of funds, is likely to be just right at the policy rate. But when you see overall, through all the segments, on average, the pricing has been at some premium above the policy rate. And when you see notably, or rather something that comes out here that is quite unexpected is this part, where you see the large banks lending to small banks has the smallest deviation if you compare. And that is besides the most likely case where you see are likely to put a higher premium because these are riskier. But what we see in the data is the most likely cause of this is because the larger banks have higher connections when you talk about in terms of getting liquidity or mobilizing liquidity. And this is because they have networks with large corporations, even amongst themselves. So they command quite a large amount of liquidity. So their liquidity cost is low. And so the premium, most of the time, is not as high as when you look at the other cases. But one thing you see also interesting is amongst the medium to medium, of all the other categories, they have the largest with peers when medium are dealing with medium. And what we see is this is mainly because even the interaction between, when you look just within the data, is the interaction medium to medium is actually very limited. But we also see that these might have, this is just a simple average. This might have been affected by the fact that when you see those structural breaks, most of the times regime 2 and 3 had even the highest deviations, others even up to 10, and this is relating to the time when interest rate caps were removed by the Central Bank of Zambia, as well as the time when the policy rate was increased to about 15.5% from 12.5% when the Central Bank was responding to increasing inflation. Well, when you look at long-range dependence using the Hest exponent, we see that there is persistence in lending. So meaning there is memory in interest rates when we see lending. So it means higher interest rates are likely to be followed by periods of higher interest rates. Lower ones to be followed by that. There's that persistence. But also, it's also affected by the structural breaks when you look at it. Particularly one time when we saw a different, because when you see this, they're all in the same range, like Jonathan had said, which shows there isn't really market segmentation. But something that's interesting in the small bank category trading, when you look at that structural break around about 2015, 2014, we see in some periods it's almost below 0.5. So meaning it was predictable. In other periods, you see it was almost unpredictable. It was almost having a Hess parameter of about 0.5, like in that case. So it shows with some policy changes, we see some kind of segmentation coming in because you see some pricing differentials are manifesting. So lastly, what we see in the paper is we see market segmentation manifesting through credit lines. It's not everybody that's trading with everybody. And we also see when you look at volumes, the volumes are, of course, even supporting the fact that with these credit lines, even the amount of volumes that are traded in each, you could see some preferences. But however, like we've mentioned, in terms of pricing, when you look at it on the overall, it seems not to show market segmentation, so to say. So we're still having more work done around it. Now will come questions, contributions, so that we could refine our paper more. Thank you.
Thank you very much. Thank you for the time. So we have 10 minutes.
I was wondering in terms of the connections between banks and the percent of credit lines, is that actual volume or just I have a credit line with this bank, or it's actual amount borrowed?
Could I pick it? Oh. Okay. When you look at the utilization, I guess you are referring to this one, right? So this is just, it's not volumes of trades. It's just the number of available credit lines and how much are being used for each segment. So the amount of credit lines that are being used when it comes to interaction, say, when the large bank is borrowing, and the medium bank when the large bank is borrowing and the medium bank is lending, you see the total could be 100%, but only 83% are used of those possible. Yes.
So my question is, how would this change if we had volumes?
If we had volumes, of course, it could look a little bit different. Of course, even when you see here, you could still see, even like for large to large, when it comes to lending and lending, you see where we're having 100%, we'll see a different picture. It could be just about slightly above 50%, and so on. So you could see that in terms of volumes, well, unless one is lending everything to, and the rest are having zero, so it couldn't give really a picture that you could could get more, but just want to see the interactions, the connection between a bank.
Any more questions? May I ask something? So have you considered reporting some measures of network centrality instead of reporting the matrices? Yeah, and saying that, for example, I mean, there's not much change over the years. You can, in fact, calculate the number of measures, of network centrality, and there are a few indices. For example, I recently discovered and used, which basically, collapse all this massive information into a single index, which shows, how it evolves over time, and then just, intensity, the closeness of connections, right? So there are some which, because there are direct connections and there are indirect connections, and there is a bunch of indices developed, to capture exactly this, right? I mean, all different aspects. I mean, I can send you the references, but I think that would be useful from the point of view of sort of sending the message and, illustrating your claims in terms of, nothing has changed, or, how much things have changed.
Okay, yeah, that's quite very valid. We'll really appreciate to have that. You're the best chair ever.
Any more? Yes, Peter, please.
It appears you do not consider this stage. So yeah, thanks. So by the way, very good paper, and very strong and well focused. But it appears at this stage you do not consider the ownership, of banks, taking any measure of ownership, whether it's by assets and whether you impose a dummy or whether you have then continuous variables. Is there any reason why ownership is not considered? Especially, there is general interest in the cross-border Pan-African banks, and I guess maybe if there are any South African banks or Kenyan banks which are in that category, that the role they play in the interbank market would be specifically interesting. And I think they are picked up in the paper that Yebai was presenting. And I think the common element, it's not true that only the multinationals, say in Kenya, are the main dominant players. The new, and there is the new cross-border Pan-African banks are becoming a big phenomenon on the continent. So maybe ownership classification might shed some light.
Yes, the work that referred to by Muhanga and others, which was not published, focused exactly on that. And what they established was that besides banks' ownership structure being critical in lending, deciding who to trade with, there was also an element of liquidity concentration, that banks that seem to have a lot of liquidity tend to drive the market. Obviously, if we wanted, we could expand on that, since the sample that they looked at was small, 3 years. Now that we have a larger sample, we could start with ownership and then extend it to bank size, just to underscore the point that probably these two elements are critical in making a decision about who to interact with in the market. We'll do that.
Thank you. Any more questions? Well, if not, then we could save some time for the next presentation. Thank you very much. And,